Hello people, welcome to the Crypto Clips YouTube channel. Yield farming is a method of earning interest and rewards by depositing your cryptocurrency into a pool with other users. The pooled funds in yield farming are used to carry out smart contracts that generate returns for everyone involved. Yield farming is a system where users can deposit cryptocurrency with other users and hope to gain investment returns through interest earned by lending pooled funds. The strategy entails a lot of risk, but it could also reward you handsomely if you are in the right place at the right time. Yield farming is a method of investing cryptocurrencies for additional returns, which typically comes through arbitrage. If you want more of this content, Crypto Clipper, subscribe to the Crypto Clips YouTube channel and hit the notification bell. Yield farms are tools that rely on smart contracts for this decentralized finance investment. For investors who prioritize aggressive returns, yield farms may provide a high interest rate. These farms can offer financial returns of up to more than 100%. When you participate in a yield farm, it is important to understand the risk. If your investment does not earn back the initial investment and more, you could lose everything. After deciding which farming setup works best for you, be sure to find the corresponding DeFi platform or cryptocurrency exchange. For example, PancakeSwap offers opportunities to join yield farms with rates from 2% to more than 200%. BitTrue also features high-interest yield farms with rates as high as 100%, which are mainly made of transaction fees, lending interests, and joining proof-of-stake liquidity pools. But remember, it is possible to lose your entire investment. Cryptocurrencies are a high-risk asset class. Although it is possible to lose your entire investment, there are risks associated with yield farms as well. Due to the complexity of these farms, they might not be appropriate for many investors. Yield farming has many similarities to a savings account, where you deposit money with a bank, and then the bank pools your money and lends it out to others while you earn interest. But instead of being converted into a mortgage or a business loan, the cryptocurrency embedded in yield farming is invested in smart contract applications. Digital currencies rely on mechanisms configured with computer code to create trust, authenticity, and accountability for private transactions. If you want to diversify your investment portfolio quickly, volatility-seeking investors may find yield farming to be a reliable option. You can use your stake to provide liquidity when it's needed, or you can invest the collateral in an interest project and take out a loan. Cryptocurrency values are highly unpredictable. It's possible for a currency value to suddenly drop while your funds are locked in a liquidity pool or yield farm. The risk of impermanent loss exists whenever you are stuck with such funds. The first step in yield farming starts with the creation of a pool of cryptocurrency assets. The steps that take place are: the first step in yield farming is creating a liquidity pool. This smart contract enables all investing and borrowing for that specific yield farm. Your business can earn revenue in two different ways. The first is by accepting an investment from a customer, which is sometimes referred to as staking. It might be easiest for you if you are the operator of an exchange or trading platform, or to sell digital goods and services in order to accept the money. The second method is to allocate your own Bitcoin directly to the liquidity pool. Smart contracts enable borrowing. They can facilitate the creation of a cryptocurrency exchange market or lending to other users. Your potential earnings will change based on the payout plan you select. You may be paid on a regular schedule or by a future date because we love your business as much as you do. When it comes to harvesting harvest rewards, there is a small fee. Yield farms are websites that require specific cryptocurrencies in order to participate. Each farm will have its own rules and documentation, so you will need to investigate what each company offers before deciding which one is right for you. Here are a few of the top yield farming companies. The Aave app makes it possible for everyone to connect their wallet with a stake or borrow supported cryptocurrency. Ethereum-based options like Bitcoin, Litecoin, and more make it number one in terms of the number of assets as well as liquidity. Invest in a wide variety of digital assets with lower interest rates and earn your money back faster. SushiSwap is a decentralized marketplace for sushi tokens. The platform's features also include an opportunity to stack or collect earnings from providing liquidity, lending your currency, and participating in the buying or selling process. Yield farming versus staking. Making a deposit with cryptocurrency is called staking or locking your coins up. It's all about generating a potential profit by holding your assets in high regard and getting rewarded for it. The process varies depending on the exchange and the currency you are pooling. The way a blockchain or smart contract tracks tokens is called governance or security. Blockchain markets rely on pledged crypto to provide liquidity for market makers, DeFi lending platforms, and to ensure that transactions can be validated. If a reward is available for staking, it's typically new crypto that was created for validation. If yield farming rewards are given, they typically come in the form of an APR. Multiple pools can be used to generate returns via yield aggregators, which act like bank accounts. Staking pools typically compete with one another in order to earn the next block, and yield farmers can use multiple interconnecting pools to improve their chances of winning this competition. However, staking is a bit different than yield farming due to the nuances of different cryptocurrency holders. Some might not want to receive interest on their deposits and therefore choose to stake their coins rather than earn a yield from lenders. Some methods of staking don't yield anything, but all stake farms depend on some form of it. Some yield farms have the potential to provide returns that are above 100% APY. Smart contracts allow anyone to participate regardless of wallet type. By utilizing blockchain-based technology, you can use decentralized finance applications to create new types of financial products. The perils of day trading cryptocurrencies. Some websites function as cryptocurrency Bitcoin yield farms. When you leave your coins invested in the farm, if it goes down in value, you will have losses called impermanent losses. Scammers and fraudsters are constantly trying to steal funds through fraudulent yield farms. Cryptocurrency transactions require tracking and reporting, which is often a challenge to monitor. Plus, farming out tasks for cryptocurrency can also be complicated. Looking to profit from farming? Start by researching yield farm investments. You can choose from different DeFi providers or centralized exchanges that offer yield farming markets. Want members to participate in your yield farm? Connect your wallet or fund your account with the correct currency. Before you can do that though, you need to create a compatible account with the needed funds for your project. For decentralized yield farms, this might require downloading and installing MetaMask or Coinbase wallet. You will need a different currency other than gas in order to buy the needed amount of currency on exchange. With cryptocurrency, you can stake your funds before they have the chance to be locked, so you will always know approximately how many days you might expect your funds to remain locked or staked. With our fuel-powered yield farms, you will never worry about being charged an extra fee or waiting on a slow confirmation process. After staking, your currency is locked instead of just securing it for a set number of days. It's easy to collect the earnings you have earned through a yield farm. Just head back to your yield farm website, click on the cash icon to make an outgoing transfer, and type in your 16-digit redemption code for donations. Yield farming is an interesting way for crypto investors to earn a return while they hold on to their crypto. It's not the easiest option, however, since it involves risk like not being able to recover your investment in the event that the cryptocurrency fails. Making money without putting in any work sounds too good to be true. That's why it's extremely important that you run your due diligence before investing. There is risk involved with yield farming, and you should know how the system works before jumping into one. Investing in this way is only for those investors who are willing to understand the risks and make changes accordingly fully. Yield farming is a process of using decentralized finance to receive cryptocurrency in exchange for your services. However, instead of earning just cryptocurrency, you can borrow or lend other people's crypto and collect it as well. Some yield farmers are able to increase their yield by employing a variety of tactics, including constantly shifting the crypto between multiple loan platforms. Yield farming is a process of maximizing rewards across different DeFi platforms. Earn cryptocurrency while monitoring your own liquidity. Some yield farming protocols include Aave, Curve Finance, Uniswap, and many others. Yield farming can be risky because there's a big potential for price changes, rug pulls, smart contract hacks, and more. Yield farming, also called yield share programs, allow investors to make money by investing in decentralized applications. Examples of the apps include crypto wallets and decentralized social media platforms. Yield farmers use decentralized exchanges to lend and borrow coins in order to earn interest and speculate on price swings. Additionally, they leverage smart contracts to make sure repayment is automated when the loan is repaid. When you deposit 2 coins to a decentralized exchange, the exchange charges a small fee. Sometimes that fee can be paid in new liquidity pool or LP tokens. Liquidity providers are people who provide trading liquidity on DEXs by depositing coins and receiving compensation from exchanges in LP tokens. How would you like to earn interest on loans you take out? Coin or token holders can lend crypto to borrowers and receive interest payments via smart contracts. Breaking down a loan into manageable amounts, borrowing can help farmers find success and increase the value of their token. DeFi is an innovative technology for decentralized finance. One of the ways it looks to be different from traditional finance is a staking mechanism, which rewards tokens with interest. There are 2 types of staking: proof of stake and liquidity supply. If a user's pledged tokens provide security on a DeFi blockchain, they are rewarded with interest in LP tokens. This allows them to earn yield twice. Calculating yield farming returns. The prospective returns are calculated over the course of a year. They are usually annualized, which is also why they have a finite return value. 2 very common measurements are annual percentage rate or APR and annual percentage yield or APY. APR only considers how much interest you earn each year, but APY may be a better option. Keep in mind that the projected short-term advantages are only estimations. The stock market is a highly competitive and volatile industry, so even in the short run, changes are difficult to guarantee. If yield farming is successful for a while, other farmers will eventually learn about it and flock to take advantage of the strategy. It ultimately stops yielding returns on investment. APR and APY are no longer appropriate metrics for the decentralized financial ecosystem that is emerging because of this platform. DeFi will need to create its own calculations for a more efficient, effective way to calculate profit per transaction. Curve Finance is a leading decentralized finance platform with over $2.3 trillion on the platform. The Curve Finance platform has its own marketing-making algorithm that makes use of locked funds more efficiently than any other DeFi platform for both swaps and liquidity suppliers. Some cryptocurrency exchanges offer stablecoins that are pegged to fiat currency. One benefit of these coins is that, as long as the peg remains intact, their APRs remain relatively high, ranging from 1.9% for liquid token to 32%. As long as your token is not completely destabilized, you can rest easy knowing your funds will be safe. By trading on a DEX-like curve, there is always the chance of temporary loss or smart contract failure. One of the unique features of Curve is its token, which is used for governance in the DAO or Decentralized Autonomous Organization. As one of the top stablecoin platforms, AVE has over $14 billion in lock-up value with a market cap of over $3.4 billion. AVE has its own native token, AAVE. This token provides benefits such as fee savings and voting power to incentivize users to use the network. There are a few different cryptocurrencies that are designed to work specifically with yield farming. One of them is a Gemini dollar, which has the highest earning interest rate for deposits and loans. Uniswap's DEX system is an improvement on other DEX systems in that it allows for trades without the need for trust. In exchange for providing liquidity, you can get fees from any transaction that takes place in your pool. Uniswap is one of the biggest trustless and frictionless platforms for cryptocurrency trading. This is great for agricultural system because it allows farmers to seize this new technology before other folks get their hands on it. It also has its own DAO governance token, Uni. One reason to use PancakeSwap is that it allows you to make cryptocurrency trades on the Binance Smart Chain network, which is very fast and easy to use. The platform also includes a few extra gamification-focused features like coin exchanges, staking pools, non-fungible tokens or NFTs, and even a game where players guess the future price of Binance coin before they actually exist. Risk is always a part of crypto trading no matter the vehicle. When you trade in crypto, you are trading with big price fluctuations and smart contract failure. You have noticed that many of the tokens in Pancake swap pools have smaller market capitalizations, putting them at risk of temporary loss. Pancake Swap offers its own token called Cake, which can be used in the platform or also that can be used to vote on platform decisions. Risk of yield farming. When markets are unstable or when debt is hard to manage, loan-based yield farmers can suffer from increased risk of temporary loss of earnings, and price slippage. In rug pull scams, newly created cryptocurrency developers collect investor funds for a project, promise to return them in a short amount of time, and then abandon the project with no intention of giving it back. This type of scam is particularly vulnerable to farmers who account for about 99% of all fraud during the second half of 2020. The Securities and Exchange Commission has declared some cryptocurrencies to be securities. This means that they fall under the SEC's jurisdiction and can regulate them. State regulators have already issued cease and desist orders on centralized crypto lending sites like BlockFi, Celsius, etc., which could impact these ecosystems if the SEC defines these as securities. That's it for this video, Crypto Clipper. Remember to subscribe to our channel, and if you feel like we have delivered value, please share this video with one person. That's right, just one person as a token of your appreciation for the hard work you put into making content that educates and helps you on your mission of building your own fortune. Remember, you can watch video after video, but it isn't until you actually take action that you will start to see results. See you soon.